Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing Qualcomm stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Qualcomm started as a contract research and development center for government and defense projects, but over the years it expanded into selling semiconductor products using a fabless manufacturing model. Fabless means it outsources its manufacturing to a semiconductor foundry. It develops semiconductor components and software mainly for wireless technology, but also for vehicles, watches, laptops, and other devices. It has been developing 5G technology for several years. The company's first 5G modem chip was announced in 2016. A prototype was demonstrated in 2017. Its first 5G antennas were announced in July 2018. It has partnerships with 19 mobile device manufacturers and 18 carriers to commercialize 5G technology. Many phones have been sold with Qualcomm's 5G technology in them, probably the phone you're using right now to watch this video. It licensed its technology to just about every mobile phone carrier in the world, as well as auto manufacturers and many other companies. That gives the company a long runway of revenue into the future. It has patents for 2G, 3G, 4G, and 5G technology. In the 1980s, the 2G standard was adopted with Qualcomm's CDMA patents. The company's name is a combination of the words quality and communications. The company is headquartered in San Diego, California, and was founded in 1985. It started trading in 91 and can be found on the Nasdaq, Mexican Bolsa, Deutsche Börse, Xetra, Vienna, EuroTLX, Swiss, Santiago, Sao Paulo, Lima, and Buenos Aires Stock Exchange. Let's get started with the model. This is a large cap company, 164 billion market cap. They're trading at 145 a share, and they have 1.1 billion shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video, and free cash flow is cash flow from operations minus capital expenditures. So they have a ton of free cash flow, 3 billion all the way up to 9.4 billion. Free cash flow is the cash that's remaining after paying all your expenses, your payroll, your rent, all your expenses, and after investing back into your business through capital expenditures. This is the money left over for you, the investor. If you invest in a company that doesn't have any free cash flow, then there's no money for you. Net income is the profit or loss on the income statement. It's revenue minus expenses. That was negative in 2018, all the way up to 9.2 billion in the trailing 12 months. Revenue is the sales for the company, and that's pretty steady in 2018, 19, and 20, but a huge jump in the trailing 12 months to 33 billion in revenue. This is the company's income statement. The top line is the revenue, the sales. Here's a breakdown of their revenue from their 10K. This is 2018, 19, and 20. A bulk of their revenue comes from China, 14 billion, 3 billion from South Korea. The United States isn't that high at 1.1 billion, then Ireland at 900 million, then 4.6 billion in other countries. Their revenue in China was the highest in 2018. It dropped a lot in 2019, but came up in 2020. Their US revenue is also really volatile. Only 600 million in 2018, 2.8 billion in 2019, and 1.1 billion in 2020. Here's a different breakdown of their revenue. They generated 16 billion of revenue from selling equipment and providing services, and licensing is 7.2 billion. This company has developed a lot of patents, so they can monetize those patents by selling them to other companies. They license their patents to cell phone manufacturers, so those cell phone manufacturers could put Qualcomm Semiconductor chips in their phones. And these license agreements go out many, many years. So it's pretty much a guaranteed fixed revenue stream. Below revenue is the cost of revenue, the cost of materials that go into making their semiconductor chips, the cost to manufacture those chips, and also the cost they pay to the foundries for manufacturing the chips. Because Qualcomm doesn't outsource all its manufacturing, also in cost of revenue is a shipping cost to mail out its products and payroll for its employees. Revenue minus cost of revenue gives you your gross profit, which was the highest in the trailing 12 months at over $19 billion. Below that is operating expenses. There's 2.3 billion in selling, general, administrative. That's mainly payroll. And this company spends a lot on research and development because they're always trying to develop the newest technology, especially in 5G. So they have a ton of operating income in the trailing 12 months at over $10 billion. It was pretty small in 2018 at 700 million. They do have a good amount of debt on their balance sheet, so they paid close to $600 million of interest on their debt. They also have some money in other income and expenses. These are investments in other companies or the sale of an asset. And the bottom line of the income statement is their net income, which was over $9 billion in the trailing 12 months. It was negative in 2018, negative $5 billion. What really stood out in 2018 was this $3.1 billion in other operating expenses. $2 billion of that was a termination fee from the failed acquisition of NXP. Since they didn't complete the acquisition for NXP, they had to pay them $2 billion. And the company was fined $1.2 billion. These are one-time expenses, so you don't expect them to recur again in the future. But as you can see, after 2018, they were really profitable. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. You could think of operating cash flow as net income converted to cash, because net income is your accounting profit or loss. It's not actual cash. So their operating cash flow goes up a ton each year, $4 billion to $7 billion. It does go down to $5.8 billion, but way up to $11 billion. So they have a ton of cash left over after running their day-to-day business. They also do some manufacturing, so they have a good amount of CapEx, $1.8 billion in the trailing 12 months. Operating cash flow minus CapEx gives you your free cash flow, and they have a lot of free cash flow left over each year. They pay $3 billion in dividend payments, but they still have a lot of cash after that. They also buy back a ton of stock, $23 billion in 2018, $1.8 billion, $2.5 billion, and another $2.5 billion. I can't believe they bought back $23 billion of stock in 2018. They also paid down $5.5 billion of debt that year, and they only generated $3 billion of free cash flow. They must have had a lot of cash on their balance sheet from prior years. This company is really generous because there's two ways to reward investors, a dividend and buying back stock, and they do both. This chart shows their shares outstanding since 2006. You can see in 2013 it was about 1.8 billion shares, but they've been buying back a lot of stock. Now it's down to 1.1 billion. So when a company buys back stock, you get a bigger piece of the pie. If, for example, there were 1 billion shares outstanding, that means there's 1 billion hands trying to grab the money. And say the company generated $1 billion of free cash flow. 1 billion hands trying to grab that $1 billion. Each hand would take $1. Say, for instance, the company bought back 500 million shares. That means now there's 500 million shares outstanding, 500 million hands. But the company still generates $1 billion of free cash flow. That doesn't change. So now you have 500 million hands grabbing at $1 billion. So each hand takes $2. So this benefits you as the investor. This is the equity section of their balance sheet. They have $8.2 billion of equity, $8 billion of retained earnings. They have no additional paid-in capital. I haven't seen this before. When a company sells stock into the market, the funds it generates from selling that stock go into additional paid-in capital. That's why companies go public, so they could obtain financing and get a big cash injection so they could expand their business. Just in case you were curious, this is what the 10K looks like, exactly like Yahoo Finance. $8 billion of retained earnings, $184 million of other comprehensive income. That's $184 million of unrealized gains. We could ignore that number. So how could a company not have any additional paid-in capital? When a company buys back stock, it reports it as treasury stock on its balance sheet. Treasury stock is a contra equity account, so it reduces your stockholders' equity. So if a company had $1 billion of treasury stock, that would reduce their equity by $1 billion. Ideally, they would report treasury stock when they buy back stock, but they don't. Some companies just reduce retained earnings. When a company repurchases stock, it removes it from the market, and that decreases the shares outstanding. But if the company wants to, it can sell that treasury stock back into the market if it needs money. Say it originally bought the stock for $100 a share. If it sold the stock back into the market today, it would sell it for $145 a share. That means they would gain $45. They would credit the gains to additional paid-in capital. But what if they bought it for $160 a share, and now they wanted to sell it for $145 a share? They would lose $15 per share. The loss would reduce additional paid-in capital, assuming there was a credit to offset the loss. If additional paid-in capital went to zero, then the loss would reduce retained earnings. The only thing I can deduce from seeing a company with no additional paid-in capital and a company that buys back a lot of stock is they may have reissued the stock at a loss and depleted all their additional paid-in capital. If I'm incorrect, let me know in the comments. There may be something else involved, but from what I understand, that's the only thing I can figure out. Let's look at the capital structure. $8 billion of equity. $16 billion of debt. They're 1/3 equity, 2/3 debt. And you might think that's a lot of debt, but you can see their net debt is $2.8 billion, so they could pay off almost all the debt with the cash on their balance sheet. So if a company has a high current ratio, and they could pay off most of the debt with the cash on the balance sheet, it's almost like they have hardly any debt. And their weighted average cost of capital is 8.16%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated the terminal value, which is all cash flows past year 4, that's $157 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $142 billion. We divide that by 1.1 billion shares. And we get a calculated stock price of 126. They're trading at 145, so they're trading at a 15% premium. It's a sell according to the model. But I think you're much better off buying a stock that I say is overvalued like this than buying an undervalued penny stock. You'll make a lot more money in the long run buying good stocks like this. The analyst forecast is for their revenue to grow 6.1%. I didn't grow their 2020 revenue 6.1% into 2021. Because it's already up 45% in the trailing 12 months. I grew their trailing 12-month revenue 6.1% into 2021, then 6.1% each year after that. That's how I got $41.3 billion of revenue in 2024. The way I calculated their future free cash flows, I figured out what percentage of their revenue they converted into free cash flow. I summed up these 4 free cash flow numbers on the top here, 3.1 billion to 9.4 billion. I took the sum of those numbers, and I divided by the sum of these 4 revenue numbers, 22 billion up to 33 billion. And that was in the low 20% range. I took that low 20% number and I multiplied it by the forecasted revenue each year. And that's how I got their future free cash flows. And you can see all their free cash flows are lower than their trailing 12-month number. Because in the trailing 12 months, they converted almost 30% of their revenue into free cash flow. So I think it's a pretty conservative approach. Simply Wall Street values the company at 108. They're saying it's 34% overvalued. 12 analysts priced this stock and the average price target was 185. So pricing a stock is a lot different than valuing a stock. If I was to price a stock, I'd probably be pretty close to 185 also. Because the market is forward thinking. They're expecting the demand for semiconductor chips to be high. A big reason is because there's a shortage of semiconductor chips. So that's why demand for these companies' products is so great. And pretty much all semiconductor stocks have been going up a lot the past year. This is where the stock has been trading the past 29 years. So in the beginning it was pretty flat for a while. It's really hard to tell in this chart. And then it shot up to over $70 a share. It came down and it never really broke through $70 until recently. And the stock more than doubled the past year and a half. It peaked at close to 170. This is where the stock has been trading the past 12 months. So if you owned this stock, say 18 months ago, 6 months before this chart, you would have been probably around $80 a share. And when the stock hit 130, you might have felt that's a good time to sell off. So you sold off and the stock price came down and you were really happy you sold off. Then it shot way up to 145. So maybe your friend laughed at you saying, why'd you sell at 130? And he sells at 145. And the following week, he's really happy because the stock came down. Then the stock shoots up to 158. And then your third friend laughs at the first 2 friends saying, why'd you guys sell so early? I'm selling at 158. And then over the next couple of weeks, he's really happy because the stock comes down to 140. He sold at 158. Then the stock almost hits 170. And then a fourth friend laughs at the first 3 friends saying, why'd you guys sell so early? I sold at 170. And then he's really happy because the stock tanks to 125. That's the thing. Who knows when the top or bottom is? Was it the first time when it was here and then it regressed down to 10-15%? Or was the top here, then it regressed to 10%? Or here? No one really knows. There's always going to be these ups and downs in the stock price. Probably in 2 years, the stock will be 200. And in 5-6 years, it'll be 250. There's no way to time it perfectly. So you can see in my example, only one of the friends out of the 4 seemed to time it well. But you could always look at past data and find patterns. But past stock price movements can't be used to predict the future stock price movements. And they pay a pretty good dividend, 1.87%. They pay out 1/3 of their net income and 1/3 of their free cash flow, so they can easily afford that dividend payment. And they probably won't raise it because they like to buy back stock. Their industry pays a 1.2% dividend, so they're higher than their industry. And their beta is 1.3, so the stock moves a little more than the market. It's gone up 26% in the past 52 weeks, while the S&P went up 31%. The 52-week low was 108, the high was 168, and the stock is trading above its 50-day and 200-day moving average. 7 million shares are traded each day on this stock. All the shares outstanding are on float, 74% are held by institutions, and 1.4% of the shares on float are shorted. Analysts aren't expecting this company to grow too much, their net income to grow 2.2%, their revenue to grow 6%. The semiconductor industry went up a lot more than the market the past year, 3 years, and 5 years. So whatever company you chose in this industry, you could have made a lot of money. Qualcomm hasn't done as well as its industry in the market the past year, but it's beat the market the past 3 years and 5 years. It is lower than its industry in those two timeframes. In the past 5 years, their annual earnings increased 19%, and it's gone up 233% in the past year. If you invested $10,000 into this company 10 years ago, you'd have $39,000 today. That's a 15% annual return. That's a great return. But look at Taiwan Semiconductor. That $10,000 would have been $142,000. That just shows you how well this industry has been doing the past several years. Their top shareholders are the big funds: Vanguard, BlackRock, State Street, Fidelity, and T. Rowe Price. Let's look at their financial ratios. For such a big market cap, they still have a pretty good PE at 18. That's stock price over earnings per share. That's better than the market median and average. Their price to sales is decent at 5.0, and their price to book is a bit high at 20. They have nearly $9 billion of intangible assets on their balance sheet. I would probably ignore price to book for this industry. If I was looking at a bank or insurance company, I would use price to book. But for this industry, they have many intangible assets that have lots of value, like all their patents. You really can't put a value on those, because patents don't go on the balance sheet unless you acquire a company with a patent. But if you internally generate a patent or any intangible asset, you can't put it on your balance sheet. It's like valuing the brand name of Coca-Cola. There's so much value there, it's not on its balance sheet though. So that's why price to book is sometimes a little deceiving for certain companies. Look at their return on invested capital, 84%. It's such a profitable company. If you feel a company has a lot of debt, look at their interest coverage ratio. It's 18. They can easily cover their interest payments. So their debt is not a problem. If you were investing in a company that had negative free cash flow and a lot of debt, that could be a problem if the capital markets froze up, because they wouldn't have money to pay the interest payments on their debt. And if they had a hard time borrowing funds, they would go bankrupt. But this company has so much money rolling in, they can easily pay the interest payments on their debt. Plus, if the capital markets froze up, big companies like this can get capital. Small companies, no one's willing to give a small company money. They have an amazing ROE at 113%. They have a high current ratio and quick ratio. They have $13 billion of cash on their balance sheet, $3 billion of inventory, and $3 billion of receivables. So they're really well capitalized. They have over $9 billion of free cash flow in the trailing 12 months, over $8 billion of working capital. Working capital is current assets minus current liabilities, and they pay $3 billion of dividend payments, so they have over $14 billion of funding. The best way to look at ratios to compare them to companies in the same industry, I've done videos of 14 companies in the same industry as Qualcomm, and if they have a number in red, they're worse than the average. If they have a number in blue, they're better than the average. So they're a lot better in PE and price to sales. I would pretty much ignore price to book for this industry. They have a good current ratio. Their ROE is over 100%, but I cap certain ratios in my file so it doesn't skew the average. So I have them at 100% ROE, 66% debt, a lot higher than average, and they're almost exactly average in market cap, and they pay a higher dividend than the average company. That's a huge market cap, $164 billion. That's the average for the industry. So to summarize, I have them trading at a 15% premium, but this company is a cash cow. Look at all the money it brings in, $9 billion of free cash flow and $33 billion of revenue. Another benefit of investing in a company in the semiconductor space is there's high barriers to entry, because it's really difficult to make a semiconductor chip. It's also 100 times harder to make one that works well inside of a phone, a computer, or another product. It could take a really long time and a lot of money to develop that. And even if you were able to make those, that's the easy part. The hard part is convincing Apple, Samsung, Tesla to use your semiconductor in their products. Because you don't sell semiconductors to people like me and you. We don't buy them and put them on our phone. Semiconductors are sold to big companies. And if a big company has been using Qualcomm semiconductor chips for 20, 30 years now, it's really hard to convince them to switch over to your product. That's why the average market cap is so high, because if you're in this industry, you're a pretty big company. So if you wanted to compete with Costco or Whole Foods, obviously it's not that easy, but it's not that difficult to open up a grocery store and get started. You just have to source your products from different places, and you do need the cash, probably at least $500,000, maybe more. But Whole Foods didn't start out as a billion-dollar company. In 1978, Two guys borrowed $45,000 from family and friends to open up a small vegetarian natural food store called Safeway in Austin, Texas. The name was a spoof on Safeway supermarket, and they were evicted from their apartment for storing food in there. So they lived at the store, and the way they bathed was using a water hose that was attached to the dishwasher. So they didn't start as billionaires like they are now. You have to start somewhere. But all I'm saying is you can't start small as a semiconductor company like you can with a grocery store or a lot of other businesses. So that's something to think about. That's kind of like a moat, high barriers to entry. I rank their free cash flows 10 out of 10, their revenue 10 out of 10, and their ratio 7 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.